Assets and liabilities form the pillars of the operations of any bank. They impact various aspects of a bank's financial state, such as risks, capital, and returns. A thorough understanding of the structure of assets and liabilities appearing in a bank's balance sheets helps decipher the bank's financial strength. In this unit, you will learn about the components of a bank's balance sheet, the components of liabilities and assets, the components of a profit and loss account of a bank, the relationship between assets, capital, and returns, the management of assets and liabilities.
A bank, like any other company, can avail of certain sources of financing to raise money for its investments. However, unlike companies, the primary function of a bank is to leverage its sources of funding and earn predictable income on its investments. As a result, the sources of funds and the application of funds are very crucial to the bank. In a bank's balance sheet, liabilities represent sources of funds and assets represent the application of funds. The following components constitute a bank's liabilities. Click each button to learn more. Typical components of a bank's assets are listed below. Click A bank's profit and loss account consists of income and expenses. Click each tab to learn more. Balance sheet numbers are strong indicators of the financial strength of a bank. The following are typical ratios used to evaluate how well a bank is performing financially. Let us take a sample balance sheet to understand various aspects of a bank. Click each button to learn more. balance sheet management aims at optimizing profitability and reducing risk. It involves allocating funds to appropriate assets to accomplish the following. Optimize income. Use diverse sources of funding to reduce risk and increase profitability. In some contexts, balance sheet management is also referred to as Asset Liability Management or ALM. A subsequent unit on ALM will cover it in detail. The following are some reasons why ALM is becoming important. Increased volatility of markets. Product innovation resulting in complex products that need proper management. Regulators looking closely at risks faced by banks. Increased competition and management focusing on better balance sheet management. As you study the subject, it will help to pause and check your understanding. Here is an exercise that will help you to do that. Read the instructions on the screen to complete the exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. In this unit, you have learnt the following. An understanding of assets and liabilities helps gauge a bank's financial strength. Liabilities consist of capital, reserves, deposits, borrowings and provisions as well as contingent liabilities. Assets consist of cash and balances with the RBI, investments, advances, fixed assets, interest accrued, tax paid in advance, and non-banking assets acquired in satisfaction of claims. The profit and loss account of a bank consists of income and expenses. Income can be fee-based, interest-based, trading income, and other income from the sale of assets, commissions, and exchange. Expenses include interest expenses, operating expenses, and provisions and contingencies. Ratios like growth rate in assets, NII, economic equity ratio, and NPAs are indicators of the financial health of a bank. Balance sheet management consists of choosing the right assets and liabilities to reduce risk and to optimize profitability. You have now come to the end of this unit. Answer these questions to see how much you know about the concepts you have covered in this unit. Go through the unit again in case you have doubts.